Right guys, good afternoon. Okay, we're gonna see one more example today to do with your taxcom, personal taxcom. So this can be relevant to, of course, students from F6. Right, if you are at P6 level, it probably will be a good thing for you to revise back your basic. Right, so one of the main things we're gonna see here, it's this thing that we normally find students get themselves confused. Alright, now we just ignore all the main conditions that we study them in the class. So it's all about the taxcom here. Say we have two married couple, both of them resident. Now what we can do here is for this husband and wife, we can compute tax for both of them in two ways. One is, we call them separate assessment. That means you assume that the husband and the wife, they are on their own. So you just got to work out how much income, chargeable income, that they'll be having respectively. Let's assume that and go through conditions with you. This is all in the class, so if you've forgotten, please, you just flip the notes, you can find them. Now, so when you combine, please remember, you must determine who combine with whom. Now, you can have a situation that wife combine with the husband. That means the husband will be the key person that we're going to work out how much is their income, and then we're going to calculate how much tax that the husband needs to pay under the name of the husband. Now we can have the husband combine with the wife, which effectively wife is the key person and the tax is computed under the name of the wife. So who to combine with whom will depend on who made the election, or depends on the situation, whether who does not have the total income. Now we're going to see all these cases over here in all these examples that we're going to go through. Okay, so that's what we're going to discuss here. Alright, now the first example I've given you is this. We say that Joseph and Janice are both husband-wife, tax resident, and Joseph is disabled. And you should be aware that being a disabled individual, your relief will be enhanced, right? You're going to get additional relief for being disabled. Alright, so now in the first case, I'm going to show you a situation that you must know what to do, okay? Now here I'm telling you that Joseph has an aggregate income of 120, while Janice is 50. Current year loss is not applicable, but 35 here, and donating cash to school library, plus purchasing a wheelchair, plus medical expenses for parent. Now the wheelchair is purchased for Joseph. It's purchased by the wife for Joseph. That's very important, okay? Alright, so what we're going to do now is to work out the taxcom, okay? We're going to work out the taxcom. So how much tax that they need to pay in this case? Now, see, I've not mentioned in the first example whether you're going to go for separate or you're going to go for combined. But if you look at the situation in the question, you will know what to do, okay? So now that's the clue, that's the clue. So if you look at the first case, okay, if you look at the first case, in the exam, if you come across this type of situation, it's how you must know what to do, okay? So you must react like this. Now, we know that combined assessment occur at total income level. And you've been told that the aggregate income for Joseph is 120, Janice is 50. Right guys, still remember what you must do is you must claim off some deduction, and according to sequence, you have to deduct current year business loss. Right, this, here you go, 35,000. Right, then you have to deduct donations. Now guys, there's a list of donations that you can deduct. So if you remember, under your 44.6, 44.6a, 44.8, 44.9, so you're going to go through all the list of donations. Again, if you've forgotten, please, let's go back and run through the notes. Go through your notes. Okay, run through your chapter 2 to revise back the rules of the donation. Now here you should know that if you are donating to library, school library, that's eligible for a deduction, and the cash donation is 23. So anything to library, the law restrict up to a maximum of 20,000. Okay, up to a maximum of 20,000. Now I just want to show the figure to let you know that maximum is 20,000. But if you look at the figure over here, you notice that Janice is just having a 50,000 of aggregate income. So even though the maximum deduction is 20,000, effectively you will not be able to claim 20. Okay, so it will be restricted to 15,000 because of the available defined aggregate income. Okay, because after 50 minus 35, you're only left with 15. Alright, so anyway, after adjusting this two figure, now you notice Joseph has a total income of 120 and Janice has a total income of nil. Now when you have no total income, no total income, now spouse has no total income. So what happened here is whenever you see that in the situation the spouse has no total income, the effect is just like the wife elected for combined assessment. You clear? Alright, so if the situation is reversed, just imagine that now Joseph, after deducting all these things, the total income is 0. And then Janice has a total income. Then the effect is like Joseph elected for combined assessment. That's the effect. So you must look at the figure and then you'll be able to see what you're going to do. Okay? So now in this case, the tax com will be as though Janice elected. So we assess under Joseph. So the total income of Joseph is 120. Now the wife has no total income. There's nothing for you to show here, and you're going to start claiming relief. So we have self-relief 9,000. Now Joseph is disabled individual, so he's going to get an extra 6,000. Right. The effects is like wife elected. That means you're going to claim wife relief 3,000. Now besides all this, we have a couple of figures here which are eligible for relief, which include buying wheelchair, medical expenses for parent. Now, so this is to demonstrate to you that there's some expenses that we claim relief. You have to incur it yourself, and there are some expenses that it's incurred by the spouse, but it's deemed incurred by the taxpayer when you're doing a combined assessment. Now, so wheelchair is basically supporting equipment. Okay, supporting equipment. And the cost of supporting equipment, you can incur it for yourself. I would just put S, self, your spouse, your children, your parent. Okay? So now the wheelchair is incurred by Janice for her spouse. She's buying it for Joseph. But, because the spouse has no total income, so whatever that the wife incur is deemed incurred by the husband. So that's why you'll be able to claim relief for supporting equipment, because it's deemed incurred by Joseph. Understand? Right, that's the amount here, 4,000. Okay, now we are allowed to claim medical expenses for parent. So again, looking back into your notes, if you've forgotten this, medical expenses for parent can only be incurred by taxpayer for the taxpayer's parent, and the deeming provision will not apply. So Joseph paid 4,000 for his parent, which of course this amount is eligible to Joseph. Well, Janice did incur 3,000 for her parent, but because the law does not apply here, so that whatever amount that Janice incurred, it will not be deemed incurred by Joseph. So if that's the case, this 3,000 will not qualify for relief. So it's a bit different with the wheelchair, you see. So that's why now Joseph can only claim 4,000 without adding that 3. Understand? Now again, it must be your own parents. Okay, it must be your own parent. And of course, there's a couple of conditions like parents must be resident in Malaysia, treatment received in Malaysia, and so on. Okay. Right, so 4,000 is the relief. So guys, this is a chargeable income. So let's do this. 120 minus 9. Right, we have a CI of 94,000. And the tax would be, so on the first 70,000, the tax would be 7,125, and the next 24,000. So hold on, check the rate. Right, guys, 24,000 will be assessed at the rate of 24%. So 24,000, 24%, 57.60. That's it. So tax would be tax payable 12.85. Alright, now I'm changing the situation now with the second case. Right, you notice that now I'm telling you Joseph has an aggregate income of 40,000. Joseph made 3,006 donations to approved charity. And the medical expenses for parents, same thing. Now Janice, same thing. I have inflated her income to 60, and I've reduced the current year loss. The library, same thing with wheelchair, with medical expenses for parent. Plus, Janice is buying a wheelchair for her mother, which is 2,000. Now both also cost of supporting equipment, so you can combine them, you see, which means in total is 6,000. Now one is for Joseph and one is for Jenny's mother, which is her own mother. Okay, right, so now we have 3 situations. First, assuming that no election is being made for combined assessment. Second is we assume that the election is made by Janice, and the third is election made by Joseph. Alright, now class, let's take a look. First case. Now the first case is we're assuming that there's no election being made. So if there's no election being made, you're going to have a tax com separately for Joseph, for Janice. Right, so for Joseph, the aggregate income 40, 60. Right, we have the current year loss 15. Right, the cash donation to the approved charity. Now there's a law limiting this to maximum 7% of the aggregate, which is 40,000. So the most that Joseph can claim is 2,008. Right, then the cash donation to the library. Now the donation is restricted to a maximum of 20,000. Right guys, that's it. So you get this as your total income. So the total income for Joseph would be 37.2. The total income for Janice would be 25,000. Right, what we're gonna do is we're gonna claim relief. So yourself. Right, each resident is entitled to 9,000, and because Joseph is disabled, he's entitled to an additional of 6,000. And we can see that there is this medical expenses for parents. So Joseph spent 4,000 and Jenny spent 3,000 plus supporting equipment. So as I said earlier, the supporting equipment is for yourself, your spouse, your children, your parents. So that's why the wheelchair for Jenny's mother will qualify because it's parent. For Joseph, Janice is buying for the spouse, so it qualifies. So that's bringing us to a maximum of 5,000. Alright, so after claiming all the relief over here, you will get chargeable income of 37,200, right, 18,002, and 8,000. Okay, how much tax they need to pay respectively? Now on the first 5,000, tax would be 25, and for Joseph, the next 13,002, tax would be 3%. That's 396. For Janice, the next 3,000 is 3%. The tax is 90. All right, now, so the tax payable would be 421 and 415. Now you notice the chargeable income in this case does not exceed 35,000. So anything that does not exceed 35,000, you'll be given a tax rebate. It's only for resident. Up to 400, and in this case will be restricted to 115. Right, so there'll be no tax for Janice, and there'll be 21 ringgit for Joseph. So that's the net tax payable. Alright guys, you notice that in the first case and this case earlier, in the first case Janice does not have total income, so automatically you're going to do it as though this is combined assessment. So you claim a wife relief here. When there is total income for each of them, then they will by default go for separate assessment. You're going to calculate tax separately, unless it's a very clear indication stated that the election for combined assessment is made. So in this case, the election for combined assessment is made by Janice and is made by Joseph. Right, there will be a slight difference. Okay, there will be a slight difference. So I'm going to do B and C together. Right, B, so elected by Janice. C, elected by Joseph. So if it's elected by Janice, you will tax under Joseph, and if it's elected by Joseph, it's taxed under Janice. Right, how do you do combined assessment? You must take total income of the husband-wife. So total income of Joseph, of Janice. Right, the total income is what we've calculated is 37,002 and 25,000. Right guys, so that comes to 62,002. Okay, 62,002. So that's the aggregated total income for husband-wife. Now that's how you combine. You get the idea? So combine does not work like consolidation. So you don't just take the aggregate and add together and then you just add the loss. No, you don't do that. You must calculate until the total income separately. Get until total income separately. And then take each of that total income and combine them together. That's how you do it, okay? Alright, so now we're going to claim relief. So now the tax relief we're going to claim is self, which is 9,000. So you either elect in this way or in this way. Now if you elect in this way, because the assessment is on Joseph and Joseph is disabled, so he will be getting a 6,000 extra. Right, the Janice is not disabled, so there's no such thing as an additional 6,000 extra. Okay. Now Janice joined with Joseph, so we will be giving Joseph a wife relief of 3,000. But in the other case, is Joseph joined with Janice, so relief is actually husband relief. Okay, so one is wife relief and one is husband's relief, and the slight difference over here is the husband is disabled. So having a disabled spouse shall grant you an additional relief of 3,500. Alright, so besides all these relief, what else that we can claim? Right, it says over here that supporting equipment. Now as you see, the supporting equipment is incurred by Janice. As I've said earlier, in the cases of combined assessment, all these expenses incurred by the wife is deemed incurred by the husband. So that's why that 4,000, 2,000 shall both qualify for relief. So Joseph can claim. And perfectly, there's no problem for Janice to claim when the assessment is assessed under Janice. Alright, but the parents' medical expenses, as I said, these are expenses that you must incur yourself, your own parent, and you can't combine them. So Joseph incurred 4,000 for his parent, and Janice incurred 3,000 for her parent, and you just have to deduct them respectively. You cannot combine them. You understand? Alright, so that's how it's going to be. So this is how the figure would be in the case that if you go for combined assessment with different person electing. Okay, let's see. We have 35,002. And we have 38,007. Okay, right, that's how the figure going to be. Alright, now how much tax you're going to pay on the first 35,000? Tax is 1,525. And the next 200, the tax rate would be 12%. 8,007, 12%. 24 and 1044. Alright, so tax payable would be 1,549 and 2,569. So you notice with different person electing, it affects your tax liability because of the way of relief you're going to claim in each cases. Which of course we can see the best situation is obviously separate assessment, that the total tax is just 21 compared with in this case. Other case is still much higher than 21. Now that's it for this illustration, but before I end here, I just want to put a small illustration ahead of this. Is now you know that if the chargeable income is not exceeding 35, you're going to get rebate. Okay, so I'm going to change the situation. Now let's say I'm going to change and tell you that if the chargeable income is exactly 35, so what's going to happen? Now if the chargeable income is exactly, we change this, if exactly 35,000, your tax will be 1,525. Now you're aware that if the chargeable income does not exceed, now it's not exceeding, right? It's just exactly 35. If it does not exceed 35, you're going to get rebate. And this is exactly what you see just now. So you've seen that rebate of 400 is given because it does not exceed 35,000. But in the law, you've been told that if a person claims spouse relief, or if a person claims relief for alimony, so you must look at your tax relief. You notice that there's a spouse relief here. If a person claims spouse relief, the value of rebate will be double. So in that case, your rebate will be double to 800. So the tax that you've got to pay will be 725. Alright guys, so that's it. That's the example that we're having for today. So thank you very much. So thanks for watching. Happy revising.